Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me, Shawn, Cruz, manager of trader services at TD Ameritrade, to discuss Nasdaq 100 performance, as there has been some rotation into value and cyclicals as they catch up to tech and communication services. Shawn, it's great to have you with us. Welcome to Trade Talks, and let's take a look at the Nasdaq versus S&P 500 earnings and performance.
Yeah, so it's been interesting to see really the stark contrast in terms of revenue top line performance in terms of growth, and then also bottom line and that earnings per share growth number as well, looking year over year. And so we've seen the S&P 500 down about 11.6% for sales, down about 9.4% for earnings per share. Versus you look at something like the Nasdaq 100, it's been up about 7.5% for sales, and then also up just over 5% for earnings per share. So when you start to ask yourself where this significant outperformance has come from, it really shows up here in the numbers. The difference between some pretty significant negative growth in the top and bottom lines for the S&P, pretty positive growth for the Nasdaq. And so I think markets were sort of pricing that in all along, and that's why you saw over the past quarter or so, past couple of months, that strong outperformance from the Nasdaq 100 versus the S&P 500. Some of that looks like it's starting to reverse a little bit now, and you're getting a rotation. And so there's two things behind that. One is I think there's a little bit of where is the uncertainty, and the uncertainty was almost constantly in terms of sitting where the U.S. economy was heading. For the rest of the year. That was a significant spot of uncertainty related to COVID. And there was less uncertainty around U.S.-China relations. And so you were able to see tech really take off. So right now we're seeing some headlines start to bubble up more and more, and some actual actions being taken on both sides. So I think that's shifting some uncertainty into tech, but at the same time you have a pretty decent improvement in COVID cases. Infection rates seem like they're starting to taper off a little bit. And that is giving some semblance of hope that maybe we can continue with the reopening. We also have some positive news coming out on the vaccination front as well. So I think really what you're seeing is not just a complete moving to the sidelines or running to get out of tech, but I do think there's some interesting value to be found. And some of these sectors that we think of as being tied a little bit more to what I call the real economy, financials, industrials, materials, things like that. So I think that's really what you're seeing playing out right now. But it is very susceptible to the presumption that we are going to continue to progress in a positive direction on the COVID front.
All right, let's take a look at some economic data before moving on to some other names. PPI shows that inflation may be popping up a bit here.
It does. And so we're looking at producer prices, what they're paying, and you can sort of start to spot out where there's rising demand and maybe not enough supply to meet that. And that certainly was the case. So you did see that positive turn month over month, and also not just in the overall looking at that core number, where you strip out food and energy and some of the trade services. But if you actually just look in the energy component itself, there is actually a pretty big pop higher as well in terms of where we're at last month. So that does show that demand was picking up going into July. And I think the real problem there is that if you start to see that get passed on to consumers, it'll start showing up in some of those headline inflation numbers. And that can put the Fed in a little bit of a tough spot. If demand starts returning and we don't have the supply to meet that demand, you will start to see inflationary pressures building. If that happens ahead of a more full reopening of the economy, the Fed could find itself in a little bit of a troublesome spot where it has high unemployment, but then also high levels of inflation, and they have to maybe try and pick and choose which one they're going to address first. So that's one thing to keep an eye on. I think inflationary pressures building is something that you want to see if it's just a little bit of a blip, or if we're starting to see a trend developing here. If you're looking at where that's getting priced in, you can look at the 10-year Treasury yield, and we saw a little bit of a pop higher on the Treasury yield today. We're now trading up around 65 basis points or so, which is still incredibly low, but at least we seem to be moving, higher in terms of the yield space. And I think that can be a good sign as long as it isn't coming from runaway inflation. But right now, just that move higher in yields, and I think some of the positive developments in the economic front are certainly helping out financials today. You're seeing some of the big banks move higher, and I think that's going to be something to watch and see if the banks and some of the other more cyclical sectors can continue to move higher and close in some of the performance that they've been lacking in relative to information technology and communication services.
All right, Shawn, with another minute to go before we wrap, Lyft and Cisco, what are you looking at for the earnings?
Lyft is going to be interesting. They're really trading at a high volume area right now. So we'll want to see if there's enough in here to really pull it away in one direction or another. Right now, the markets are pricing in about a 10% move post earnings in either direction. So not expecting it to go below 27 or above 33. So we'll see if it's able to stick this level or if there's some sort of surprise. Had that new headline come out of California around how they have to classify their drivers as actual employees. It'll be interesting to hear from management what they say about that in the call. Cisco, another one I really like to watch when they report earnings. Not quite as big of a move expected here, about $2.30 in either directions for the post earnings range. But Cisco's just such a massive company in terms of its footprint in corporate spending. I always like to listen to management and see what management's seeing from the demand side of things to get a feel for what's really happening on the ground. So two earnings reports that are worth one, not only seeing what comes out, but also listening to management and hearing what management has to say.
Yeah, excellent point on Cisco. Shawn, thanks as always for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.